How's it going, everybody? Hello and welcome to the morning show. We do this every morning at 8:30. I'm your host, Steve Strazza. We got JC, our other host, backstage right now. We're all alone today. No Spencer Israel. So doing this on our own without our producer. I think we'll get through it. We'll talk Fed. We'll talk a little bit of earnings. We have some M&A news. So get out of bed, make your coffee, wake up your neighbors. It's time for the morning show. Hey, good morning, sir.
What's up? Are we live?
Yeah.
Hell yeah. Let's go, baby.
Quicker intro than usual. Spencer typically has more to say. Did you miss my intro?
I did. I missed it completely.
Wow. All right.
Yeah, was it a good one? Or did it suck?
I don't know. We'll have to go back and see. I think it was okay.
You think it was good? What do you guys think on the chat? Was it a good intro? Thumbs up? Do we get a thumbs up?
Where's Spencer? Get out of here,
Where's
Rachel.
Spencer? Get out of here, Rachel. You got everybody you need right here. Are you kidding me? Come on.
So apparently we don't talk about news enough at the top of the show. I got Fed news for you. You want to hear it? We had a big...
Nope.
But
there's no news. Nothing happened.
Actually, it did. They're dot plots.
My God. Here we go. It was a 99% chance that nothing would happen. Nothing happened. So what's there to talk about?
So did you see Andrew Thrasher's tweet? He said he likes Dippin' Dots more than Fed Dots.
That's, I think a lot of people hate on Dippin' Dots.
They're terrible.
So much. No, they're not.
I've never had them, so I can't say.
You've never had Dippin' Dots?
Why would I eat that when I can eat?
What kind of deprived child are you? Like, are you kidding me? Shame on your parents. Shame on them not giving you Dippin' Dots.
Not once.
It's the ice cream of the future. And now here we are in the future, and it's still not. So
I would walk right by it to pretzel time every time.
Wow.
Yeah.
Never had Dippin' Dots. Okay.
Space ice cream. That's
hold on. No, but we got good feedback. We got good feedback because, people are watching the morning show. They like our just kind of keeping up with what's going on in the market, but people are watching it pre-market. They want to know what's going on this morning.
Yep.
Okay. So 99% chance yesterday that nothing happened. Nothing happened. And now you're telling me that there's something to talk about. So go ahead, share with me.
All right. So here's some analysis that's coming out this morning. The Fed's hawkish stance spooks investors, though some say peak rates are near. So now the Fed is trying to say, like, there's one more hike coming. They're not quite done yet. Like, this is just kind of like a little pause, but we're going to get more. Fed fund futures are saying no way. I'll look at the updated numbers this morning for Fed fund futures. I'm sure they moved a little bit, but the Federal Reserve's plans for a prolonged period of elevated interest rates could continue pressuring stocks and bonds in coming months, is kind of what everybody's saying. So that end rate where they had their dot plot moved down by 2 cuts, so 50 basis points from what I understand.
All right. You get it out of your system? You get it out of your system?
Yeah.
Are you happy about it?
We'll see.
What does that mean to me? Tell me, somebody who's dumb and stupid and doesn't like follow the Fed minutes or whatever, what does this mean to me?
It means that the Federal Reserve is telling you that interest rates are likely to stay at more elevated levels for longer than previously planned.
All right. So again, what does that mean for me? Sell TAC and buy energy? All right.
I can't tell you what to do with that information. If you don't like knowing what the Fed is planning to do, then that's on you. I think it's helpful as context as an investor.
All right. I think it's a distraction. Speaking of distractions, I have said on multiple occasions, and we're going to talk about one more thing before we get into the state of the markets, right? Strazza, we're giving the people what they want. Do we not? What do the people want? The people want more of what's going on in the morning, and they want more of you and me disagreeing. So, hey, we're checking both off right off the bat here on today's show. See, we don't even need Spencer for this. No, listen, I have gone out on the limb and said on multiple occasions over several years that the junkiest stock on StockTwits, which is by definition, a place for junkie stocks, in my experience,
Yeah.
is Splunk.
Really?
Anybody who brings up Splunk is a junkie. And by the way, there's nothing wrong with being a junkie and looking for beta. There's absolutely, so I'm not like saying this is a negative. I'm just a characteristic of, retail investors. And Splunk to me is like the name.
It's really interesting because what you're describing is there's like this strange underbelly in the investing world on some of these platforms where the stocks you would think would be most popular are not the most popular there. So
Right.
one of our friends, I think you passed it over. I think it came from a different platform, but it was tracking some sort of follows or media mentions, that table that you sent over.
Yeah, we're working on it. I'm not working on it. I'm working on it, and I hooked him up with like Grant to help him out with spreadsheets and stuff.
But did you see some of the names that had like the most mentions?
Hating on you yesterday.
Who was?
Strazza, he's like Strazza doesn't know how to use Excel. I'm like, ooh,
Who said that?
Riley hating on Strazza. Yep. I'm like, wow, that's a low blow for someone like you. Like, you could say that about me. I'm not gonna take offense to it. I'll probably even agree. But for Strazza takes this very personally. I'm just saying.
I think you're just trying to like stir a pot. I find it really hard to believe that Riley would say that.
I found it pretty hard to believe also, for the record. Anyway, my point of this is that Splunk was bought out by Cisco. Talk about the blind leading the blind, huh?
Finally.
Throw up the chart of Splunk there, Giancarlo.
So I'm surprised by what some of the hot stocks on these platforms are. I was just gonna say like energy fuel stood out to me on that list, but Splunk would be another one. But this isn't like not profitable tech, JC. This is
not.
A big
Splunk
company.
makes money.
Yeah, they've been around forever. They make money, real business. Yeah.
What about Cisco? They just suck, huh?
So that actually another one. I have a good buddy, it turns out, who works for this Clavio.
For the record, I'm no fundamental analyst, but according to my data, they do not make money, Splunk. So no.
Really?
Yep, it's a shit company. Well, now it's Cisco's shitty company. So
let's see. Let's double check.
I have data too. They don't make any money. So it's a piece of hot garbage. All right. So that is the news for the day. So you got Strazza and me disagreeing already on the Federal Reserve. You got the news for the day. Can we hit the state of the markets? Can we do it?
They have had negative net income for the past couple quarters.
It's a piece of hot garbage.
Yeah.
Congratulations, Cisco. Hit it. All right, folks. So today, for the state of the markets, listen, there's a lot going on. We covered everything on the conference call earlier this week. If you're a premium member of All-Star Charts, make sure you give that a watch. If you are not a member of All-Star Charts, just contact us, and we will figure out a way to get you access to that video. Call Mary, ping me. You know where to find me. I'm easy to find. info@allstarcharts.com, and you can check that out there. That's the best way to get caught up. But today, in the state of the markets, I want to talk about some of the relative strength that we're seeing in cybersecurity. Right, this market correction, I know everybody's freaking out this morning and everything about like, oh, the stock market is down. Yeah, it does that. It does that this time of the year too. This is perfectly normal. In fact, if the market wasn't behaving the way it has been lately, that would be really weird. So the fact that the market is acting perfectly normal is not an excuse to be crazy and take crazy pills and go on Twitter and freak out, right? That's silly. Can we show that chart of Palo Alto?
Who's taking crazy pills?
Pan W. What's that?
Who's taking crazy pills?
The Twitterati. Dow, NASDAQ futures down a stick. They're freaking out. They're like, oh my God. They're freaking out. Oh my God. If the market wasn't behaving this way, that would be really unusual. So
can I just say, I don't understand all the pills on the internet. The blue pills, the red pills, the purple pills, the crazy pills. There's all these pills.
There's the orange pill, right?
Orange pill. Yeah.
Orange pill. Yeah. It's like a meme thing. It's how the kids talk these days.
Okay. All right.
So Palo Alto Networks, PANW, showing a ton of relative strength. Like surprisingly so, particularly during this correction. No?
Can we look at credit spreads quickly? Did you just talk about credit
Why
spreads?
are you? Why? No.
Sorry.
What are you doing?
All right.
Is this the state of the markets,
No, this is a
or is
good
this
one.
the Strazza show?
This is a good one. It's been a strong one. Some cyber stocks are working.
In an environment that tech's been getting hammered,
Yeah,
in an environment that interest rates have been going up,
sure.
right?
Yep.
Doesn't that make sense?
For this one,
Okay, now let's go to the next one. This is Checkpoint
yep.
software here. Again, we're just getting through these former highs from the tech bubble peak, but you kind of like eliminate that left side of the chart, and it's really been a steady uptrend for a long time, hasn't it?
I can't see. Okay, yeah, I was just gonna say, make sure you zoom out on this one. I love
Cheating.
this.
Do you think it's cheating to take out that left part of the chart, or?
No, you got to leave it there. This one looks like Oracle, right? It looks like this is a massive .com bubble base. We've seen patterns like this resolve higher in the past, and you always want to be involved. Love these patterns. We lost JC. So basically, Checkpoint runs all the way back up to its .com bubble highs. This was, 7 years ago now, 2015, 16. Chopped straight sideways, right? Because we talk about how important certain prior cycle highs are. In this case, it's taking 6 or 7 years to absorb all the overhead supply here. When this thing finally goes, you're going to get a nice leg up.
Yeah. And even in the short term, so bigger picture, it looks great. But in the short term, since the new 52-week highs list peaked, which was on July the 12th, Checkpoint's up 9%, dude. How do you feel about that?
It's up how much?
9% since the new 52-week highs list peaked back on July the 12th. So to me, that's really, really impressive. So, when we talk about the state of the markets, when we talk about what's going on, I think it helps to put certain groups in perspective. The fact that some of these quote unquote software stocks, it's cybersecurity more specifically, but nevertheless software, nevertheless tech, in a correction led by tech to the downside with interest rates going up, and these things are holding up great. Very impressive. One hole wants to know, how does JC set stops? How does he avoid getting stopped out? Well, first of all, the only way to avoid getting stopped out is to not trade at all. But one hole, email us and I'll have Peter send you a primer on how we approach this. And it'll explain everything. So not to take too much time here, but yes, if you want to avoid getting stopped out, just don't trade at all, right? Getting stopped out is part of the game, right? It's like, you're a baseball player. You're going to pop in, you're going to pop out. You're going to hit into a double play. You're going to strike out, right? That's part of the game. You go out to play defense for a few innings, then you come back and maybe you'll get another chance, and then you'll hit your grand slam. But probably not. You'll probably ground out again, right?
Well, the question, the question was specifically, how do you choose stops with these news events? I don't think it changes what you do based on the news.
Yeah, no. I mean, I ignore the news altogether, right? Life is better that way. Yeah, life is better that way. Okay, well, this is the state of the markets brought to you by Key West and the New York Giants.
Why do people have such a problem with my outfit today? I don't look like I'm ready to step out on the golf course. Actually,
yes, you do. Yes, you do. Yes, you do.
Whoever
said that is absolutely right.
I don't golf in this. This is not breathable at all. I would never golf in this.
Well, you have trouble breathing, and you're a sweater regardless of what you're wearing.
It's not a golf shirt. It's a coaching shirt. I identify more with coaches than players these days. Do you feel that way? Like when I'm watching the game, when I used to watch the game, I'd be like, yeah, the players. But now I feel like I'm more like a coach. 35 years old. Like, so I'm wearing this instead of my jersey for that reason.
My wife says you dress like a dad.
I love Morgan. Tell her thanks.
Yeah. She says you dress like a dad. So I saw that you dropped the Young Aristocrats here. Are you saving this for the
This is my spotlight. Don't jump my spotlight. I'm not ready. Spotlight should come at the end of the show. Like it's like a finale.
You jumped with the credit spreads, man. Like, can I live?
Listen, well, I got to read you this. You're gonna like this, and you're gonna want to address it. So, listen, we got a lot of friends in FinTwit. Michael Guyed. You heard of him?
I have. I was on his Twitter Spaces once.
A credit event is here. Maybe in China, Michael.
I guess. I don't know.
Do
I don't know
credit?
what that means. What is a credit event?
That's how people say like bad things in the bond market are here. A credit event, like a liquidity event. Like that's a bad word. Credit event.
I don't know. I don't know where I would get his research. Does he write research? Like how does this work?
I don't know. I think he does a lot of Twitter Spaces, but
There's a lot of Twitter. I don't have time for that.
if you look at
So I don't know what that means. Credit event.
this is all.
I don't know what credit event means, but I feel like there's a credit event every day, right? That's the market, right? I mean, yesterday there was a credit event, was there not? The Federal Reserve talking about credit and doing things with credit, like isn't that so? Every day is a credit event, so I don't know what that means. So I ignore that sort of stuff. But you can look up at top here at the credit spreads. Here we're looking at high yield bonds versus U.S. Treasuries, right? So these are junk versus Treasuries, and I don't know what a credit event means, but if there's going to be real selling pressure in the equities market, if there's going to be a major correction, if this is 1987 all over again, if this is the end of the financial system, blah, 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 all that stuff that you hear on the Twitter, if that's the case, you're going to see it in credit. And maybe this is what Guyot is talking about. I don't know. But you're going to see it in credit because you can't hide. It's such a monster market. There's nowhere to go. Either you're going to get if stocks are going to sell off, it's going to slip into what's happening in credit markets, right? Maybe that's what Guyot's talking about. But you haven't seen it yet. Actually, all we've seen is the exact opposite, right? All we've seen is a bid in high yield bonds, particularly relative to treasuries, as treasuries are selling off. So I'm just not seeing these credit spreads. And you also see it, and it's not just in high yield, you're also seeing it in sovereign debt also. So, stepping away from the United States. I know a lot of people with their home country bias, but if you look around the world, we're not seeing that. Now, with that being said, these credit spreads are less leading and maybe more coincident, right, than anything else.
Mm-hmm.
But even with that being said, we still haven't seen credit spreads widening at all. We're going to have Rob Koyfman on in just a hot second, and I'm really looking forward to what he has to say. I'm actually going to ask him about this. But a couple of things to add to this chart. So we're looking at credit spreads on the top. In the middle there, you're seeing high beta versus low volatility. And we are seeing that ratio rolling over and making new lows. So we're getting, for the first time, we're getting a slight bid in that low volatility. Haven't quite seen it in consumer staples relative to discretionaries. Because, Straz, I don't know if you watched the morning show, but Amazon is the largest component of consumer discretionary, has zero weighting in the S&P Tech Index. And that has really been driving this ratio higher, and have not seen, at least not yet, that rotation out of consumer staples and into out of discretionaries and into consumer staples. Haven't seen it yet. So if there's a lot of selling pressure coming, this is 1987, end of the financial system, blah, blah, blah. I think you're going to see it in credit spreads, a credit event, if you will, if that's what he means. Haven't seen it yet. And you're also, in my opinion, I think you're going to see it a bit in staples, and you haven't seen that yet either.
No? High beta rolling over on a relative basis kind of called this action in the consumer ratio, right? It's been weak. It's been weak.
High consumer beta versus staples? Oh, the high beta versus low vol.
High beta low vol was moving lower, while XLY XLP was moving higher through the summer, and we were kind of like,
yeah. But you want to know something? It's been more of a high beta weakness and less of a low vol bid.
Yeah.
Right.
Yeah, you're right.
Yeah. Can you listen? We're gonna bring Rob Koyfman on just in a second. But we have the chart summit. Giancarlo, can you drop the link? Or Spencer, if you're in there, can you drop the link of where people can register for Chart Summit? This is on Tuesday and Wednesday, guys. So Tuesday night, we're going to have a little welcome session on the 26th around 4:30. We're going to have a nice little panel discussion. We're going to have a fireside chat. We're going to have a little happy hour. So this is on Tuesday, the 26th. And then on the 27th, all day, balls to the wall, 8:30 to 5:30, all day. Some of the best presentations you've ever seen in your entire life. Some of our good friends, Ryan Dietrich, Ari Wald, coming hot in the morning. And of course, some of your usual favorites from All-Star Charts, and some of the friends that you see here regularly here on the morning show. Why don't you play that little trailer there, Giancarlo? Show the people what we got.
Time for the 2023 Chart Summit. Mark your calendars and sign up now. The event is on September 26th and the 27th. This year's Chart Summit will bring the best in technical analysis straight into your living room or home office. Either way, this year's guests are JC Parets, Steve Strazza, Kimmy Sokoloff, Patrick Dunawilla, Ian Cully, Ari Wald, Melton Demirs, Brian Shannon, Christian Tharp, Frank Capilleri, Jeff Hirsch, John Netto, Kenny Glick, Ryan Dietrich, Joe Fahmy, Willie Delwich, and Tyler Wood. Join us on day 1 for a virtual happy hour with traders and on day 2 for a full day of education. Go to chartsummit.com to register for free today.
Listen, not for nothing. That was pretty good, Giancarlo. Nice job there, buddy.
Thank you, bro.
There he is, the voice of God. I like it. I like it. Listen, it's going to be awesome. I'm personally looking forward to my one-on-one conversation with Melton Demirs. She always gets my mind thinking. She approaches the market in a very different way than I do, and Strazza and some of the others. So really, really interesting conversation I'm looking forward to. Also, Brian Shannon, hello. I kind of just skipped over him. Kind of a big deal. Brian Shannon, a longtime friend of ours, friend of the show. Ari Wald, Dietrich, what presentation are you looking forward to the most, Mr. Strazza?
I can't say my own. Probably
No.
David Lundgren.
Lundgren's going to present a chart summit? Does he know that?
I thought he was. No?
I don't know. Is he? Are we letting a surprise out of the hat?
Oh, was that supposed to be a secret?
I don't know. Is that a secret? Oh, I don't know. I guess you're just going to have to register and find out.
Ari's good. Brian's always good. Frank will be great. Dietrich.
There's a lot of good ones in there. There are a lot of good ones in there. Joe Fahmy making an appearance. How about that? Joe Fahmy coming out of his cave, talking charts. I like it. I was like, Fahmy, man, come on. He's like, I know. I was like, where were you in California? He's like, oh, I didn't know. I'm like, that is such bullshit. The fact that you weren't there. So anyway, Rob, you here? Rob in the house. All right, JC, cool. What's up?
JC, are you presenting? Because I know in the past we've had such killer lineups that you'd have to back out of presenting because the schedule was so full.
I think one year I didn't present because the schedule was so full and we got hate mail and death threats. So I think I'm gonna have to. I'm gonna have to say a few words. You got to give the people what they want, Strazza.
So is Spencer emceeing the whole thing? I'm presuming.
I don't know. I think you're just letting too many surprises out. I think you're just telling people too much.
One would assume.
Guys, Giancarlo, play the bumper. Bring in Rob. Yo, Jay, we've been friends for a long time. Make the call.
I mean, this is pretty professional, guys.
Nice show you got going here.
Mr. Koyfman.
What up, JC? What up, Strazza?
You know what I keep telling Strazza? I'm like, Strazza, go drive up to Miami, get a boat, and take Rob for around the bay there.
Such a good idea.
We never did it. For a while there, I thought I was going to get a boat and Rob would come visit me in the Keys. We've never gone fishing. Just a bunch of Miami guys not being out on the water.
First of all, you're not a Miami guy. Stop fronting.
I could be. Close enough.
Stop fronting. You're a member of the Conch Republic. Proudly so.
JC, last time I saw you, you were Christmas shopping at Future Proof for all the swag.
I was. Let me tell you something. It was well worth it. I had to borrow a suitcase from Giancarlo to bring all the crap back. But I got to tell you, sitting down in the middle of the living room with this little mini suitcase full of all kinds of just swag from all kinds of vendors and fintech companies I've never heard of, my daughter had such a great time. But what is this, Daddy? Oh, this is a tape measure from E-Money. She's like, ooh, loved it. All kinds of little rubber things. The boys, I got twin boys. They're playing with all the little balls, the Orion balls, right? I mean,
Orion.
Orion, yeah. See, Orion balls.
They have great tees. They give away great t-shirts.
The balls just paid for themselves. There you go, Orion.
Yeah, there you go. Shout out to Orion. I'm not really sure what Orion does, but I'm sure they do a heck of a job at it.
And you got 2 future customers 18 years from now.
Yes, sure. Doubt it.
Are we all hanging out in Miami in a few weeks? are being
If you're not wearing if you're not wearing that shirt, we are probably.
Well, most of the people we're going to be with are from New York, so there'll be a lot of people wearing that shirt. So I'm going to be the weird one at the party, by the way.
I'm going to have my jersey on.
Nice.
All right. So we're going to be at Dolphins play the Giants in Miami in a few weeks. We will be there. We got a Cuban guy, setting up the tailgate. 10 a.m. Rob, be ready.
I'm there.
All right. So Rob Koyfman, I say this a lot, Rob, and I really, really mean it. And I'd love to hear your thoughts on it quickly, and then we'll get into what the market's doing and everything. But I am friendly with practically all the CEOs of all of the technical sort of charting platforms out there at one point or another. I'm either good friends with them or I've met them, and all of them are coders, tech guys that are trying to get into the finance game or got into the finance game, but they're computer science first, right? They're coders first getting into our business. You're the first one, maybe even the only one, that's one of us, right? One of us that got into the coding game, that got into the software game, right? So you understand what we need because you've been there better than any other founder of a charting platform, because they're just trying to figure it out like everybody else. Can you touch on that? I think this is a really important point.
There's so many subtle things that you like, whatever your craft is, whether it's technical analysis or you're a software engineer, or you're a dentist or whatever it is, by doing something for many years. And I was doing investing for 15 years, which is a long time, but not that long, I guess. And just understanding kind of like how investors look at the market. And I also had the good fortune of being a fundamental analyst, a macro strategist, trading options, working on the buy side of the hedge fund, and got to see how the sausage is made. Got to see what people look at, and also used all these other platforms out there and kind of had a view on what's good, what's not good. And yeah, it helps a lot. And speaking to users is my favorite thing as in this job, and just seeing how they're using the software, what advice and what suggestions they have, what feedback they have, where they're finding problems. But yeah, having a head start of just understanding and having an intuition of when you get feedback of like, oh, this is good feedback, this is not good feedback, this is something that's really interesting. That's a really big part of what we do, and I think why we've had so much traction in the investor community.
And it's the nicest UI of all of them. Like, you look at some of these platforms, I'm not going to mention any names, but you look at some of these platforms, they look exactly the same as they did 20 years ago, right?
Yeah.
It's embarrassing, really.
Rob, your charts look great, and we love it. We love you for it.
Yeah.
Thank you.
I think the default should be a thicker line. Defaulting to a thin line that nobody can see, defaulting to a thicker line that you can make thinner, right?
I think we increased the default thickness to it used to be thin, now it's normal. You want it even thicker,
more girth,
more girth. Okay, like a can of Pepsi.
That's right. And the other thing that I want you see, since we got him on the show, now I'm gonna talk about my Christmas shopping list here. Also, implied volatility, right? You talk about trading options. Implied volatility in the individual equities is very, very important, so we can decide how we want to approach this market. Should we be selling some premiums? Should we just, volatility is cheap relative to itself over time, plotted below price?
Yeah, I would personally love to have implied vol on Koyfin, and it's
easy math, right? Isn't it easy math?
It's easy math. It's real easy math. The data though is not that easy to get. It's actually, the current implied volatility is pretty easy. What I want to do is get a full history, so you could look at kind of where implied vol is now versus history, and I have all these
that's
ideas.
Exactly right. That's right.
Of how I want to treat the Greeks and how I used to do it. But that data set is not kind of like that easy to get, and that's why we've been sort of putting it off. But
Rob, you're the man. If anybody can get it, it's you, baby.
I know. Got to talk to the person around here who makes the decisions.
That's right. That's right. Okay. All right. So that's a couple of things that I just wanted to mention while I have your attention.
I was saying yesterday, JC, just to say something nice to Rob now after you.
I was about to say something nice.
You could both say something nice.
Yesterday that Rob has the best data. Any other of these vendors that we use and we go to, I have to double check the data. I'm spot checking their data. I don't do that with Koyfin. I know where Rob gets his data. I know that he knows how important it is to have correct data, and we don't have that problem. So
Rob is more hardcore about his data than I feel like we are. So we trust you, Rob. You're very trustworthy.
You're saying about how he's a finance person, right? Yeah. So he knows that he needs a reliable source for his data. Some of these other vendors we use, not so much.
All data is not created equal.
That's right.
Garbage in, garbage out, right, Rob?
Garbage in, garbage out. That's right.
I'm going to say something else nice. I love, first of all, I love how you listen to us. Some of these don't listen to us at all. And you know what? Screw them. But you do listen to us, and I appreciate that. So thank you. Can you talk about, we mentioned it the other day with Linzin and Pearl Dog, but here on the morning show, can you talk about, the sell side analyst ratings and, when stocks are doing really well and Wall Street is just on the wrong side of that, the squeezes, the unwinds that this creates are just unbelievable. One of those is Aon. We've been talking about that. Aon is a reinsurance company. It's been making new all-time highs, like, I don't know, every day, maybe every week, every month. And it's been doing that for a long time. That's not anything new. And out of 19 firms that cover Aon, AON, 19 firms, only 2 have a buy recommendation on it. Like, what?
Yeah. So as you know, the positioning data is super important, and there's a lot of different ways of measuring positioning and sentiment. One of the kind of most the best signals out there is just what Wall Street thinks about it, because a lot of times Wall Street is a reflection of other investor sentiment on the stock. And so on Koyfin, you could look at the average rating on the stock. So on a scale of 1 to 5, 1 being a sell, 5 being a buy, what's the average rating? And so love the setup of looking at sells that are basing and starting to move higher, right? That's like awesome, kind of seeing like the market is saying something, the analysts haven't been there. On the flip side, people where analysts are super bullish and the stock is starting to gap down. That's super interesting. The other thing is the percentage price target versus where the stock is. So looking at that difference of kind of the average Wall Street rating is 200, the stock's at 100. That means there's 100% upside, or conversely, if they think there's downside. And as you know, Wall Street analysts tend to be bullish, so typically there's a lot more upside than people say downside. And then the number of analysts, like, hey, if there's like 0 or 1 analyst covering it and the stock's moving, that's also interesting because it kind of tells you no one's in it. On the flip,
talk about that a little more. Like these stocks that are just undercovered, a lot of time it's because they're just really good businesses. They don't need to raise capital, so the sell side's just kind of uninterested in them.
Yeah, there's different reasons why Wall Street covers stocks.
Could be closely held.
The reason that a stock is good or interesting is like number 10 on the list, right? Like Wall Street doesn't cover stocks that are interesting. They cover stocks that typically generate revenue for the bank and other parts of the business, whether it's mergers, acquisitions, IPO, debt deals. And so if a stock and also kind of like management has to be involved in the investor community. So there's a bunch of companies, particularly small companies, where Wall Street doesn't cover them because the companies don't pay via debt deals or whatever it is, or equity deals. There's also a bunch of mid-sized companies that have very few analysts covering the stock, and that will sort of tell you that there's just no institutional participation. We recently started putting 13F filings, so institutional holdings on stock, so you could see kind of like where hedge funds own a stock or where they don't own a stock. That's kind of interesting. Yeah. And so we'll be looking at historical trends there.
So you're going to do the 13F data and just upload that quarterly, or are you going to like also include Ds and Fs?
Yeah, so the 13F data is first, and I think the 13Ds and the 13Fs are part of the same data set. And so right now it's the snapshot today. The next phase is to get it historically to kind of see the trend and also kind of show you aggregate numbers, hedge funds own X% or the trend over time. And then the next phase is to actually get the insider buys and sells. That's the other data set we want to get in there. And then the other data set, which you guys have used before, is the short interest data, is just seeing short interest and really seeing kind of like where are investors like super bared up and where's the potential for a squeeze. So as you know, there's no one indicator that'll tell you what to do, but kind of building that combination and reading, creating that mosaic and connecting the dots. That's kind of where we help you in providing that data.
Yeah, you have a lot of these unique data sets all in one place. I was just thinking to myself, as far as the 13Fs go, and even Form 4s, the insider buys and sells, nobody really does that well.
Yeah, except us
for free. Oh,
we do it well.
We're not a data provider.
We're not we're not a data provider. But there's nobody on the planet. There's nobody on the planet that breaks down these filings better than we do. I can say that.
We literally do it ourselves because there's nobody reliable enough out there.
Yeah, the only reason I can say that is because we looked. It doesn't exist. Because a lot of these things are like in the footnotes, like in the 27th footnote. Like so, like there's no algo you could like program to figure it out. Like there needs to be a human involved if you're going to do it right.
We've tried, we've had conversations, and we have good guys who are working on it. They automate it as much as they,
Which filings do you mean? Which filings are you referring to?
The Form 4s, really.
That's the insider.
Yeah,
that's the insiders, because some of these times it's like planned purchases, or sometimes they're like options being
automated.
Exercised. Yeah. Like that's not anything we're interested in. We want open market transactions.
Yeah. Sounds like we're gonna have some stuff to talk about when we start doing the insider.
Because it's not as easy as just sourcing it to like the box of the form and saying if there's a P there for open market. It's no, because then we want to remove the 10B5 ones, and that's buried in a footnote. So it's
sounds like we have a lot to talk about on the boat ride.
Let's do it.
Nice. And I appreciate that, Rob, because some of these amateurs out there, they just publish the data, right? Like they don't care.
Yeah.
They're not traders, they're not investors. They're just like, it's a Form 4. It's because he's buying so much. It's like, bro, he didn't buy anything.
Yeah, look at the green dot. It's a green dot.
There's a P. It's not a P there. We're looking for the P in the filing, right?
Yeah.
Hey, everybody's loving your artwork, Rob. You want to tell us about it?
Yeah.
Absolutely. It's a piece I saw on Etsy. I think that he had just the bull, and I basically contacted him. I was like, "Hey, can you do a bear and a logo?" The guy did a good job. Actually, the first bear was super much fatter and looked lazier, and I asked him to redo the bear to make it a little more fierce, because the bear markets are fierce. They're not fat and lazy. Got the Koyfin logo and the bull and the bear on Etsy. It's awesome. I like
it. Etsy's kind of like Sotheby's, right? Same thing.
I mean, that's where if Van Gogh were alive today, he would have started on Etsy.
Let me tell you something. I just ordered something on Etsy more recently. My wife decided to marry a Patriots fan. If you could believe that. So they don't wear Miami Dolphins gear. But Vince Wilfork.
Did you wait? Hold on. Just stop. Your sister decided to marry a Patriots.
You said your wife.
Okay. Oh, what did I say? My wife?
You said your wife. Yeah, that's.
Oh, no. Furthest thing from it. No. So my sister's husband is a Patriots fan, right? So then they had a little girl. So Vince Wilfork went to the University of Miami, so he's the man. So I got this little girl who wears 10 pounds, a Vince Wilfork Patriots jersey, which I find hilarious because he's like this giant, enormous man, and she's like this little white, little nothing, So anyway, I got it on Etsy, and so shout out Etsy. Terrible stock though, right?
It had the COVID bump, and now it's given a lot back.
It looks like a 0. And then what about you, Rob? Like we're firing out questions to you. We're telling you all these things. Can you tell us what you're seeing in this market? Is this the end of the world?
What do you want to talk about, Rob? What
Look, I caught the tail end of your discussion in terms of like all these bears and kind of seeing the end of the world is coming. I could definitely relate to that feeling because we've never had the Fed raise rates this aggressively so quickly. And it does seem really strange that nothing broke. Like you'd figure something breaks from a macro perspective, but definitely don't want to be Pollyannish and dismiss risks and stuff like that. But I'm looking at all the stuff that you mentioned in the market to really try and understand, are there any kind of signals that are being given? And, looking at some of the cyclical trades that you've highlighted. But, one of the, I don't know what bear you were talking about, but a lot of people talking about 2007, when stocks were rallying into 2008 and stocks were making all-time highs. Like you've said before, credit markets peaked in 2006 and were going down in 2007. They weren't rallying. The other thing to look at is rates, is looking at the 2-year yield.
Can you be more specific with when you say credit is going down? What does that mean?
Yeah, so credit, just looking at high yield spreads. Spread of high yield versus treasuries. We have, if I can I share my screen here?
Yeah. Can we handle that, Giancarlo?
Can we handle that? I think we can.
Oh, we can handle it, y'all. Let me.
Oh, I
see.
love
Are you available? Are you sharing your screen? I'm waiting to see a little screen from you, Rob.
Yeah, let me just share my screen here.
And the viewers want to see Koyfin.
Live Koyfin charting.
They want some live Koyfining.
Wow. See, I knew Rob would want to talk about it.
And Rob, I'm going to now share your screen if you're ready.
I'm ready. Yeah.
All right, here we go.
Thanks, Giancarlo. So, in Koyfin, this is the homepage, and where I went is under this market dashboards. This is where we organize a bunch of macro indicators for you, in case you don't know what the hell the ticker is. And so, if I go to corporate credit, we have all the kind of corporate credit indices here. Yep. And so, if I highlight, let me just highlight U.S. high yield. This is kind of U.S. high yield broad. You could also highlight a more specific one. Yeah. And then in here, you could select kind of the total return, the effective yield, the option adjusted spread. And so this would be the spread over treasuries. And if I were to click this arrow, that would load up this ticker in security analysis. So let me just hit that.
So when people talk about credit spreads, you hear credit spreads. This is what they're referring to.
This is exactly, well, there's investment grade credit, there's high yield credit, and then there's total credit. But high yield credit spreads are just much more sensitive because it's the lower tranche of the capital structure. So these would be much more sensitive to any kind of change in economic activity. Right. By the way, JC, you don't think this is thick? This is pretty good. This
Can you move our faces, Giancarlo, so we can see the chart?
Like this, like you don't think this is good? You want it to be thicker by default? You want it to be?
That's definitely thicker than it used to be.
Yeah, so this is the default. This is like a little too fatty for me. But.
Yeah, we like the fat boy lines, but
yeah, we like it fat. I like to see the girth so that you can really see it. I want it to pop like bang.
Got it. Okay, I like big lines, and I cannot lie.
So charts a lot over here.
So charts a lot.
Yeah.
And so if I'm looking at kind of like the 2007 episode, this was a much different kind of episode. This is like over here was Bear Stearns, and that came back, but this is a much different trend in 2007, 2008 than it is now, right? It's kind of like we had the spike. It's been sort of consolidating here. Look, anything could happen in the future. Doesn't mean that it's not going to spike again, but if the end of the world was imminent and kind of like there were some corporate events, there was some economic data that was starting to suggest that, this line would not be sort of at the lowest point that it's been since 2022. That's kind of like one way to think about it. The other way to think about it is if I look at the 2-year spread, which is which is kind of like the short end of the curve, and I look at the spread here. 2007, the market started anticipating the Fed is going to lower rates way before kind of like all the stuff started happening in 2008. So, that's not what's happening right now at all. And we've had we had the regional banks and Silicon Valley Bank and the market repriced rate hikes over here earlier this year. But we're back to the highs. And so the credit market, the rates market is not seeing any sort of doom and gloom that some of our Twitter friends are seeing, and 2-year yields are trading near the highs. So,
I mean, that's a pretty big deal. We're talking about the level that these yields were at right before the great financial crisis.
It's the same level, right? So, but if you look at kind of like historically since the 80s, like this is the weird part, right? Not this. This is kind of normal.
This is a monster trend reversal is what this is. And this
Rob, do me a favor. Rob, do me a favor. Thicken that line. Look how nice it pops. Thicken that line.
This is
show the kids how to do it.
This is
thin.
So okay, so no. So here, so this is my template. So I have this saved, but when you create a new chart, the default is medium. But you're right. This is a little.
Look at that. Maybe a darker blue. Wow. Look at that, baby. Pop. See, now we're talking. Let's go.
Now
it's blue that makes it work. Yeah.
Now I see what you're talking about. Exactly.
You see what I'm saying, Rob? You know? Come on. This is beautiful. This is art.
And so if I did the mean and 1 standard deviations here, do you know you could do this here? The
more standard deviations, the better is what I always say.
When you look at a chart of interest rates, you're not supposed to log your scale, right?
You're not. That's why I changed it to linear. Yeah. So you
says who? Who says you're not?
Listen, it's kind of split, but that's most people's answer, and that makes a lot of sense.
It's not split. It's because percentages aren't prices. Because the reason you
look at a percent of a percent or log
the reason to log prices is because a change from $5 to $10 is a $5 change, which is not the same change as $30 to $35. That's a different percent change. With percentage changes, that math doesn't work because you are what a log does is it normalizes everything to percent, but a change from 1% to 2% is not the same way as logging a change from 9% to 10%. It's a different math because you're looking at yields, you're not looking at prices.
But at least we can agree that supply and demand works on pure price, not total return, though, right, Rob?
Don't even get me started, JC. We should definitely have a show, a segment about this. I will.
I mean, if you really want to debate me, I mean, I love you, Rob, but you're not going to come out of that looking good.
Well, I think we should. One, have the debate. Two, I think you should be open-minded. I think one of the things that I think you have a very strong view, and you know what the test here is. I don't think you can explain to me, or I don't think you can repeat or argue my point of view here. I don't think you know what my point of view is. I know what your point of view is, and I could tell you why I disagree with it.
Can we take a shot every time that we agree? Throughout to see how long we last, you know what I mean? Or it should be every 5 minutes we take a shot, and then the last man standing.
I'm all for this debate happening, and I think you're right, Rob. He's so passionate about his position. It's like he doesn't even listen to you when you're trying to explain yours. That's what.
Yeah, I feel like we're married, and you never do the dishes.
Now that does. Fortunately, I have a dishwasher, or we would have serious problems in my household.
Yeah, but loading the dishwasher is still annoying.
All right,
Rob, one last question.
No, I get the last question. Before you go, what is the Fed's next move? Hike or a cut?
I mean, JC, you could ask. I don't know. JP said hike, so I believe him. I don't know.
Okay, I like it. Thanks for having an opinion. Thanks for playing.
He's just making you feel good. He doesn't give a shit.
But wait, what? It's one. What's the difference if we know he's done or we know he's done, but there's one more? It's the same thing. Who cares?
Thank you.
No, but I do think he's going to hike one more time. But who, the market,
market doesn't.
Yeah, but who, it's.
I know.
See how nice it is when Rob and I agree. Isn't it nice?
I thought Rob? I just agree, but I don't know whose views. Wait, I think he said he's going to hike, so I think he's going to hike. He doesn't. He's typically I think
they're going to hike more. No, we're
more than one.
Yeah, I think so. Yeah,
because
who cares? Who cares?
Yeah, well, if they're gonna hike...
something more important here, way more important. S&P 5,000 or 4,000. What do we see first?
Team 5,000.
Woo! Let's go, baby. Let's go. All right,
Hey.
Rob. Rob, we gotta go. We gotta hop. Rob, you're the man.
Hi, Rob.
Love you guys.
Love you, Rob. Keep up the good work,
All right, bye.
and we'll talk. We got things to talk about.
We got things
Football games to tailgate for.
adjusted, unadjusted.
Horse and football.
Yeah, let's go,
Later.
baby.
All
All right.
So
Everybody, go to Koyfin. Go to Koyfin.com.
Yeah.
Right. Koyfin.com. Koyfin. Koyfin. Koyfin.com, and start using those charts. If you're not, I don't know what you're thinking. It's a fantastic platform. I don't know of a single platform on this here planet of Earth that's going to get you more data. And by the way, a lot of the data that you're going to find on there is tough to get.
And a lot of it's free too, which is ridiculous.
And a lot of it is free. So get involved. And let's talk about what's happening in the market today. Giancarlo, you want to bring Kimmy in? Hit it, baby. Kimmy Sokoloff.
So he says 5,000 first?
I agree.
You do?
I don't really have, I don't have that strong of a feeling about that. My suspicion is, I don't necessarily have a bet on that right now. I don't think he has a bet on that either, nor does he seem so convicted on that, but it's just a guess, one or the other. I don't necessarily disagree.
I have a bet on the next Fed move being a hike. $100.
When's the next
I have a
move?
bet that you're probably going to bring it up again before the end of the show.
When's the next Fed? When's the next Fed?
Too soon, probably.
I don't know. Next month.
Look at you with your Giant shirt on.
Yeah, I'm very excited for the game tonight.
Oh, they
Wait,
play
did
tonight?
you see last Sunday? The comeback?
Wasn't that great?
That was unbelievable.
I had to come back.
Who do the Giants play tonight?
They looked so good in the second half last week. They play the 49ers.
Ooh, where?
I don't even know if it's a home or away. I didn't pay
Doesn't
attention.
matter. The Niners look pretty good, huh?
Right. So we'll see.
Kimmy.
Market, yeah.
Are you happy that this Federal Reserve nonsense is now behind us and now we can trade peacefully?
Yeah, I don't know if it's peaceful still. I think we, it's going to be a little bumpy. We're getting hit this morning pretty good. So we'll see if they bounce them today, if a dead cat bounces or not. It might be a bounce to head back lower. I've spoken about, a certain pattern that I've been seeing in the S&P, whether it fully develops or not. I think, where are we at? 4,400 in the S&P. We break that. We got a little bit of a downdraft going on, so we have to see if we hold on to it. A rally back above 44.25, we could get a little bit of a short squeeze, but we'll see. We still have the end of this month to see what goes on, and sometimes the market doesn't really get moving to like the first or second week in October, typically for the bounce. So we'll see what that,
Correct me if I'm wrong, Kimmy, but if the market wasn't behaving like this, if it wasn't messy, if we weren't getting sell-offs like this, that would be incredibly unusual, right?
Yeah. This is typical, and it's hard. So like yesterday when I traded, I said, I'm going small. It's like we're going right in front of the Fed. I stepped in front of it. Obviously my longs are getting hit, but I, got out of a short. I was in CELH. I was in a short for couple weeks in that, like 3 weeks. Finally came down into target yesterday. I covered a little soon, but then I got a little aggressive. I jumped back in. Sometimes I do that. My shorts are like dissipating, meaning little by little, meaning they're starting to get filled. I've been short for a while. We'll see. Maybe today I get filled or not. We'll see if they bounce them or not. And then now I have some longs on that I got a little hit yesterday, but I traded very small. So if I need to stop out, I stop out.
On a day like yesterday, you're active before the meeting, then you try to just be flat.
I wasn't flat. I stayed in. One thing I did get stopped. I had to run out. So I didn't get to tell the room. I did stop. I say, guys, the Fed's coming. Keeps your stops in place. Today you just don't know what's going to happen. Either they're going to rip it. I said yesterday morning, the spies are either, it's 9:25, gotta go. The spies are either going to jump to 447.70, or we're going to drop down to 435 to 437. This morning we're down at 435, right? 50. So we're in the zone. That's what I put for yesterday morning's note. And we are here this morning. It was either we're going to go a big spread down, a big spread up. And now we're on the lower end of the range. So we'll see if we get a little oversold bounce or not. So
Some ugly.
Kimmy,
Yeah.
so you're talking about positions that you had on and all that stuff is fantastic. 3 for 4 yesterday. Nice day as usual. But coming into today, you're looking to put on a short on IWM, right? You're looking at it from the short side?
No, maybe a dead cat bounce.
Got it. You're looking for a
I
bounce.
wouldn't mind. Listen, there's a gap at like 176 something, right? But it might bounce up first. I have to see the way everything acts. I could get caught.
That gap from early June, right?
Right. It could be tough trading. I got lots of gaps down. I have to see the way they handle the gaps. It might be fast trading. I'd say either don't trade because it's sloppy or size down. Size down a lot.
Man, if the IWM starts creeping back above 182, I think you're looking at a pretty hard squeeze.
Yeah, but right. So I'm just
back
looking
above
for
those like mid-August.
Oh, what'd you say, JC?
Those from a month ago.
Yeah. All right, I got a hop.
All right, Kimmy, go do your thing. Go.
Have a good one.
Opening. Folks, if you are interested in joining Kimmy every day, email us and we'll get you going. If Spencer was here, he'd drop a pretty link. There would be a QR code. Ho! John Carlo dropping the QR code like it's hot. Hit the QR code and join Kimmy in a room so you can see these trades in real time so you don't have to wait till the next day when I'm like, Kimmy 5 for 5, Kimmy 3 for 4, as usual. She's killing it. I've never seen anybody. Dipman sent me her latest stats. So this goes exactly 1 full year of her trading room, and she has over an 80% hit rate. It's like 80 point something or 81%, something like that, which is crazy. Like, I've been doing this for a long time, and I've never seen anything like this. So kudos to Kimmy. Like 92 Fish Gut says, good job, Kimmy. Agree wholeheartedly.
JC, what do you want to talk about next? What's the deal?
Well,
with this?
I'm gonna do a quick rundown of the futures, and then I'm gonna throw it over to you. So, ladies and gentlemen, Dow futures down 160 points. I don't know what everybody's freaking out about. It's 45 basis points. S&P 500 down 80 basis points on the futures. NASDAQ futures really leading the way to the downside today, down 120 bips, 1.2%, well off the lows for the day. Bonds are really the big mover here today. 30-year futures down 1.6%. Interest rates working on new highs across the board, across the curve, which will be really interesting if they can stick it. But as Charlie Dow taught us 140 years ago or so, it's closing prices that are most important, not pre-market. Gold getting slammed today, down 1.5%. Silver down twice as much, down almost 3%. Copper down 2.5%. Metals getting slaughtered. Crude oil up again today, up 1% in the green. And the dollar pretty flat today, which is interesting. You would think that with some selling pressure in equities, you'd be getting more of a bid in the dollar. You are not. Volatility is certainly picking up today with interest rates up as well. And that is the morning rundown brought to you by the San Francisco 49ers.
So this is what you would call a decisive upside resolution. If you're looking at something like the 10-year.
Are you really going to call that already? Market hasn't even fucking opened yet.
Dude.
What do you mean, dude? Don't dude me. The market hasn't even opened yet. You're talking about a decisive resolution. What are you talking about?
Yeah, that's exactly what it is. TNX is literally gapping higher, up 3%.
And at the lows of the session so far. You want to keep going?
Dude. All right. Okay.
Market hasn't even opened yet, and you're talking about a decisive resolution? Like, no.
Bond market opened.
Yeah. And has it closed?
Okay.
You let them dance? Let them dance, man.
Why
aren't you the one who always says pre-market is sloppy, low liquidity, blah, blah, blah? And now here you are talking about a decisive resolution in arguably the most important market on the planet, and the market hasn't even opened yet? Are we going to split hairs?
It's taking the shape of a decisive. This is what we would call, if this was 4 o'clock or the market's closing, and that candle looks like this right now. This is a decisive upside resolution. You got the gap at this key level That's literally called a breakaway gap. There is a textbook technical analysis term for what this is shaping up to be.
You are so full of shit. The
It's a
market
breakaway
just opened breakaway gap. What the hell are you talking about? Potentially.
I need a
Potential breakaway gap. Potential breakout. Yeah, maybe. Let me see it. I got to see it. Can we let them close?
For tomorrow's show, I'll bring a chart of the breakaway gap in the 10-year that's printing right now. But
maybe.
Okay.
But you don't know that. You have a crystal ball now all of a sudden? You've been hiding this from me all along?
It makes sense that would be the action today, following the news from yesterday, too.
What news? It's literally no news. What news?
That the Fed is going to be higher for longer. Rates are going to
Oh, my God.
Yeah.
I can't even with you. Okay, can we do a little Strazza spotlight? Giancarlo, you got a bumper?
I wanted to talk about housing. Maybe we could talk
Got a
about
bumper? He's getting a little ahead of himself with this breakaway gap. Market hasn't even freaking opened yet.
breakaway.
I got a hot corner. I don't think I have the Strazza spotlight bumper.
You need a Strazza spotlight. What are you doing, Giancarlo?
Oh, look at this. Look at this. How about the logo of the show? Check this out. Blah.
What logo?
Strazza show. There we go. That's all I got.
I don't see a logo. Do you see a logo?
No, I want
It
to talk
says
dividends.
The Strazza show.
Yeah, you see it. It's Strazza show.
Oh, I see it. Oh, yeah,
Guys
it's too
do
little.
that when you were out for a week.
It's funny. It's funny, but it's so little you can't even see it.
All right.
You know, I don't have the other. Yeah. All right. I'm doing my best.
You just
Am I hating today? Am I hating?
You hate everything today. What happened?
I don't hate everything.
All right.
What do I hate? My biggest position is in energy, and oil's up 1.5%. I couldn't be happier.
You doing all right? You sure?
The Dolphins are the best team in the NFL. My Miami Hurricanes are undefeated. My biggest position is the only thing up today. I don't know. I think I'm doing pretty well. No? Am I wrong?
What's your biggest position?
Chevron. It's really the only position that matters right now in my portfolio. I don't have much else. Yeah, I'm in. I'm happy. Who's happier than me, man? I'm just saying, like, you're making these like grandiose proclamations about breakaway gaps in a market that hasn't even freaking opened yet. Let them dance. Let them dance. Can we can you want to do your Strazza spotlight? Show us your aristocrats.
Very interested in the price action from tech stocks today. Yeah, so let's throw up the dividend table. Let's just talk about dividends for a second here. So this is something we discuss a lot internally, and we've been doing this for a long time now, scanning for what we believe are the best dividend stocks. What I want to say is that traditional dividend investing on Wall Street is so flawed, right? We are taught as investors to go after a company with a big yield or a juicy yield, or even if you look at some of these dividend growth strategies, they're investing in names that are paying at least like 1, 2, or at least like a market average yield, right? They're making sure they're growers, but they're big yields. They are intentionally filtering out the lowest dividend paying stocks, right? The stocks with the lowest yields. We have learned that that is an awful thing to do because often the best stocks among dividend payers on a total return basis are the ones with the lowest yield, for the simple reason that the math in quantifying a dividend yield depends on the price of the stock. So you have a stock that never stops rising, it's going to keep pushing the dividend yield lower. You don't want to filter out names from your universe because they have such a strong stock price. Those are exactly the names that we want, right? So when we look at dividend investing, we don't care if we're getting paid by a dividend or by price appreciation, right? We're looking at it in total. So today's example, I think, is just like a shining illustration of that, right? Because we have this Kinsale Capital, KNSL, insurance stock. You know, these stocks have been really strong, just slowly grinding higher. Some of the leaders really right now in the market from a subgroup perspective, 0.13% yield, JC. Am I crazy?
Yeah, because it's a grower, not a shower.
So are we crazy to include this stock? I mean, who pays a 0.13% yield? They must never hike this thing, right?
Can you just throw my chart in here for a hot second? Throw my chart. It's slide 1 here. This is why what you're saying is true. And it's similar to your chart, but this is a little cleaner. Okay, so ask your question again.
Which one? Should we remove a stock like this from our dividend universe because the yield is too small?
is this the type of stock you'd like to remove?
And that's
Or is this the type of stock you want to make sure is in that damn list?
exactly. So if you start filtering out dividend paying stocks because of low yields, you're going to be filtering out a lot of charts that look like this. So when we look beneath the hood, looked at the fundamentals for KNSL, they have like a 6 or 7% payout ratio right now, which means that the current cash flows can 10 times over, maybe 20 times over, cover their current yield, which means at any given moment, they could double that yield, triple that yield, quadruple that yield. And you could be looking at a stock that pays 1.5% dividend, right? Over the past 7 years, they've consistently hiked their yield about 20%, sometimes more than 20% every year, right? They're growing earnings, they're growing revenue, their cash flows are growing, their payout ratio keeps shrinking. So you're going to probably see a big hike here or some sort of buyback program. A lot of times you get it in a different way, right? If they have that much capital to give back to shareholders, they won't always do it through dividends. Maybe there's a big buyback there, and that's what keeps, sending the price of the stock higher. It doesn't really matter to us because, like I said, whether it's price appreciation or the actual dividend that's getting us paid, it's all the same. Money's money. Stock like KNSL with a 0.13% yield that's growing consistently at 20%, and the stock just doesn't stop rising. These are exactly the names we look for in our dividend scan. And I love that because I think that is radically different from any other dividend strategy. This would be filtered out any other dividend investing fund.
That's right. Throw up the actual scan itself, slide 3. Basically, what Strazza's saying is that the way to make money in dividend stocks is to not buy stocks that pay high dividends. It's actually a great way to lose money. You want to be buying the stocks that are consistently raising their dividends every year. In this case, we're talking about an insurance stock that has raised dividends every year for 7 straight years. Rachel's talking about NVIDIA that pays a dividend. NVIDIA's already graduated from this list because this list is companies that have raised dividends for every year between 5 and 9 consecutive years. I think NVIDIA's like at 11, right? Strazza, something like that?
We like to get them young, Rachel. We have written about NVIDIA through Young Aristocrats in the past. It was on our list originally.
But great example, right? NVIDIA already graduated because it's been raising for too long.
Eli Lilly is another one, I think. Fonz, do we have the actual dividend bar chart here? Can you throw that up?
What dividend bar chart?
Yeah, okay.
So hey now, where did this come from? I haven't seen this.
So the dividend yield is shown here in the line, right? And the actual dividend, right, per share amount of the dividend being paid is in the bar chart. So they're steadily growing this thing, but the yield just can't keep up because the stock price is moving too fast. It's not a bad thing, right? So it's just math. And we see it a lot in some of the best paying names. Like you said, NVIDIA is one. Lilly's another one that's been on the list before. Small dividend.
I'm getting this. Where is this from?
Trading View.
Oh, okay. No, I'm asking. I don't know. Yeah. Nice. That's pretty cool. I've never seen this before.
Yeah, if you open up the right-hand panel on TradingView, I checked the financials. You got segment revenue, you got dividend information, you got everything. It's great.
Oh, all right. Shout out TradingView. Look at us giving shout outs to all these charting platforms. Very cool. I like this chart a lot.
That's all I got.
I thought you did a pretty good job. That didn't suck.
It's important, right? Because getting caught up in these high dividend paying stocks, I don't think is, a unique issue for your average investor. I think a lot of people fall into this trap.
Because it's kind of like common sense, right? Like or you would think it's common sense that if you want to make money in dividend stocks, is that you buy stocks that pay high dividends, right? Like kind of like logic, but that's actually the exact opposite. That's what you want to do if you want to lose money, I think, because you see it all the time. Because if they're paying such a high dividend, it's probably because the numerator's gotten destroyed, right?
I want a stock that has the ability to pay a high dividend and consistently grow its dividend. Right? Because then that just speaks to the underlying strength of the business. It tells you this is a great business to be invested in. Like something like Kinsale, 5% payout ratio. What are they going to do with all that cash?
I want to address one question. I think you'll do a good job of addressing it, and then we'll bring Sean in. Stephen Green, Stephen Geheen. Perhaps I'm missing something, but are we not looking for companies with excessive free cash flow? Money they have to do something with? That's a great question. Why are we not doing that, Strazza?
No, that's exactly what this is, right? So when I talk about the payout ratio, I'm just telling you that after they pay that dividend, they have a ton of free cash flow left around. That's what the payout ratio is telling us. A lot of these utility stocks will have a payout ratio like 70%. It's telling you that after they pay their dividend, there's really nothing left. So that's exactly what this is.
But there's companies that have all this free cash flow that don't do that, like Berkshire Hathaway. Don't they have like a ton of free cash flow?
Yeah, and that's why they buy back a ton of stock, right? So that's
Do
my
they?
point.
They buy back a lot of stock. Okay.
Yeah. So that's my point. I don't care how they're returning cash to shareholders. I care that they have the ability to return cash to shareholders. If you have the ability to return cash to shareholders and you're not, it's only a matter of time before there's an activist at your door making sure that you return that cash to shareholders. So, and that's what the payout ratio does. It's calculating the dividend yield versus the free cash.
I thought that was a good question. See, I mean, the chat killing it there.
Does that make sense? Like a lot of the names on our list, Kinsale, I should probably check, but I'm sure they're buying back a lot of stock too because they have a lot of cash to do the shareholder return activities with.
Then why not rank the companies by the amount of free cash they have? In my opinion, it's because that doesn't necessarily translate to a stock that we want to buy, right? But it doesn't not do that either.
Well, because if we just looked at the companies with a ton of free cash, right, it would be chock full of REITs and utilities and staples, but that free cash number wouldn't be taking into account how much of that cash is locked up already paying a dividend, right? So by looking at the payout ratio, we're analyzing the free cash after the dividend is paid.
Explain the payout ratio. It's a good point. Explain
The payout
that.
ratio is the dividend yield divided by the free cash flow.
Downtown Matt Brand asked a good question. Is there a way to tell if they're hiking dividends too much?
Yeah.
Putting compression on that free cash flow. It's a great question.
The payout ratio will blow out. That's why we have to look at that, right? If somebody increases their dividend 4x and the payout ratio goes from 20% to 80%, then you kind of say, can they actually service this yield?
We rank them by relative strength generally, price-wise. Right? I mean, we'll rank them, maybe we'll anchor to certain dates or something like that, like performance from a specific date. In this particular case, we're ranking them by relative strength. So once they fit the profile, they just join the universe, and then we'll rank by what's actually happening.
Yeah. Is there a way to tell if they based on? Yep. Yeah, we do. We rank. We filter it simply by proximity to new highs. Right.
Yeah.
For the strongest.
Simple. Do you think Google will pay a dividend someday, or you don't care? I honestly don't think so.
I think so.
I don't think so. Their money is. I'd rather have my money with Google than have my money back.
Here's the thing.
Because Google has inside information. They have data that nobody else on the planet has. So there's a reason why Google Ventures is so successful.
So your point is you want them reinvesting and taking shots with that cash.
Yes.
And
if I'm a shareholder of Google, which I'm not, we own some call options, but I wouldn't consider myself a Google shareholder. Like someone like Howard Lindzen, for example. Howard Lindzen's been long Google forever, buys more, sells some, but he's always like long Google. Yep. And part of that strategy, I haven't asked him about this, but if I were him, one of the reasons why I would have that is because I trust Google's data better than I trust my own data, better than I trust anybody else's data, because they have very, very unique inside information as to what people are looking for. So they could just use that cash and buy things or build them, right? I'd rather my money be invested with them than with me.
I agree with you, and they'll keep doing that. You know, Google has become, for a while now already, one of these masters of the universe companies, right? They can do everything. They control Silicon Valley. They're basically venture capital firms too. All of these big tech companies now, because they have so much cash. I think it's only a matter of time. That cash balance is only going to keep growing, JC. Somebody's going to get in there and do something similar to what you saw at Apple once they hit a certain state of maturity, I would think. You're going to get some sort of shareholder return from Google.
Apple doesn't have the data that Google's got. I think these are apples and oranges, two different things. Matt Brown says, aren't you buying Google for the growth of technology, not dividends? That's exactly right. That's exactly right. Why don't we bring in Sean? Hit it, baby.
They'll pay one day.
Doubt it.
They will.
Nope. Shawnee, baby.
Oh. Hey, buddy.
Looking sharp,
Shawnee.
man. Looking sharp. Sean's on mute. Come on, Sean.
Sorry, guys. My computer did the old software update overnight and reset all my settings, and so nothing was working this morning. So I apologize for.
Listen, but you're looking great, man. That's all that matters. You know, you got that 25 Delta vibe going. I like it.
All right, look, we can agree on that. Let's keep the agreeing going. I think the audience has spoken. They're tired of you guys acting like little bitches, arguing all day. Let's have a constructive
Well, then
conversation.
don't say little bitch things around me. Then that's all good.
It's actually the exact opposite. The feedback we're getting, Sean.
Yeah, they complain when we agree too much.
That may be the case in the past, but I'm not getting that vibe today.
All right. Well, all right, Mr. Smartass. What are we buying today?
We're not buying anything, man. We're selling everything. No, just kidding. Busy market this morning, boys. I'm not gonna lie, it's a busy morning for me. But
I gotta tell you, I like it when Sean talks to me about uranium. Like that's just not something. When I think about Sean, I just don't ever see him pounding the table about uranium.
I don't pound the table on uranium. I just like ticker symbols, and that NXE is one that we were talking about yesterday, and I like it. Although I like it less today than I did yesterday, if I'm being completely honest.
But isn't that why we buy call options?
That's precisely why we bought call options, to limit our risk for this very scenario. So what JC's talking about, what we're alluding to here, is yesterday we were looking at that NXE chart and loving that it ripped higher over the past, I don't know, 3 weeks, 4 weeks. And it was just kind of flagging up there around just north of $6 a share. And I commented to you guys, I said, look, this is one of those hard trades. And the hard trades are the ones that pay the most when we get them right. But the way we could participate in the hard trades and make them a little easier on ourselves is to position ourselves in a way that we limit our risk. So if we're dead wrong, we don't get hurt all that bad. And we looked at the options market and we saw that we could buy February 7 strike calls and pay only 60 cents for them. Which is what we did. So we are long NXE February 7 calls. We paid 60 cents. So we're not looking so hot today, but hey, we've got time and we're just getting started.
Howard, I was talking to Linzen yesterday. Another Linzen shout out. That's 2 in one day. We need to stop that.
That's too many. That's far too many.
Too many. It's far too many. So Linzen, I was talking to him about call options, and I was like, it's it's a limited partnership, right? You're a limited partner. That's how I look at it. And he liked that. He's like, ooh, he's like, why do you call it an LP? Because you can't lose more than you put in. I'm like, exactly. He's like, oh. He's like, I need to learn options. I'm like, call Sean. You might be getting a crazy phone call.
Now that you're speaking his language, you have his attention.
Yeah, no, you might be getting a crazy phone call one of these days. Be like, hey, Sean, what's up with these options? Huh? What are you guys doing?
Howard Linzen likes to play the buffoon, but he knows what's going on in the options market.
He does like to play the buffoon. He's been playing the buffoon for a long time, but he's anything but, huh?
Yeah, he's a smart cookie, as much as I hate to admit it.
Yeah, he's a smart guy. He'll figure. I told him, I'm like, listen, the options trading is not very difficult. It's really simple, especially the way we do it, right?
Right on. Yeah,
keep it simple, stupid.
All right, so one thing we should talk about here is in light of what's going on today, and I wouldn't have said this yesterday, but with the way the S&P is acting today and stocks in general, I mean, it really just furthers what we've been talking about for the past 6 weeks, is that we're in for sideways longer. We think we're in for sideways longer. And with volatility spiking a little bit today, I mean, I just want to keep looking for delta neutral trades. Now, yesterday, I would have said to you guys, hey, let's start looking for these long trades. In fact, this is why we got into NXE yesterday, is because we were starting to think that, look, if this market is going to resolve higher soon, the leaders are already showing their hand. We need to start positioning some of these leaders. But today's action is kind of reversing my thought on that. I think we're still going sideways longer.
But hold on. So there's 2 things. First of all, the NXE trade is a February expiration, which is 5 months away. So that's number 1. So when we're talking about and volatility in energy, in particular in uranium, has been super low. So you can just do what we are doing and go out as far as possible and buy calls and go out 5 months out into the future. In other sectors, that's not the case, right? In other areas, you have volatility slightly elevated. So I wouldn't just blanket the whole market with where volatility is in energy and uranium. Would you agree with that?
I do.
And if you are going to be collecting some premium today, which I would like to actually, we're not going to look at energy to do that, right? We're going to look somewhere else. And we want to find the messiest mess we could find. And I got to tell you, there's you got quite a selection to choose from. Am I wrong?
No, you are not wrong. And so I like our chances over the next few days to find some more delta neutral credit spreads to put on. And look, they've been working for us, and nothing wrong with keeping doing what's working, right? I mean, it's been 6 weeks more or less that we've been putting a lot of these trades on, and I don't want to jinx it, but I feel like every one of them has worked or close to it. I mean, it's crazy.
I got a couple of messies. Anheuser-Busch for one. Qualcomm is another. You want to take a look at those. Anheuser-Busch is just a mess, like a messy. It's like a long-term mess. It's a short-term mess. It's just a messy mess in one of the worst performing sectors. So my suspicion is volatility might be a little elevated there. You can confirm that or not. Qualcomm also messy mess.
The problem with the Bud is I think you know where I'm going to go with this one. We got earnings coming up on the 26th.
Damn, earnings are always getting in the way.
26th of October, excuse me. I mean, we could play it a short term with the October options.
Of October, it's too short, right?
I mean, you could do the October options. They expire before earnings, but I'm not sure.
I know, but aren't they going to be slightly elevated as earnings approach, though, which defeats the entire purpose of what we're trying to do?
No, it doesn't defeat the purpose. It's what you want. You want elevated implied volatility.
Not if we're selling them.
No, you do want elevated premium if you're selling
now, but when we plan on taking profits and buying them back.
Oh, right, of course. But these options, October, I'm looking at Budweiser. The October monthly options expire before earnings. So they're really not going to get the earnings pump in the premium, right? Because they're going to be done before earnings. So we could do it. I just, there's only 29 days of expiration, not my sweet spot for putting on
How much are we getting?
Trades. Well, looking right now, if we did like the 55.60 strangle, we'd get about 77 cents. Not a whole lot.
55.60. Yeah, that's not worth it.
Yeah.
And what about Qualcomm?
Let's see. Qualcomm, we got a little bit more time till earnings till November. So we could do the October weekly expiration that expires on October 27. That gives us 36 days. So that gives us a little bit more time, therefore a little bit more juice. We could, I'm just doing this quickly here. I'm not sure I would want to do a strangle on this one. I don't like being naked risk on a stock like Qualcomm, I don't think.
Why? What's wrong with a stock like Qualcomm?
I think it could move a lot more. It's $110 stock. I feel like that could hurt if you get caught on the wrong side of a big move. You could do a iron condor, selling the 100 puts and the 120 calls.
Yeah.
And protecting $10 away on either side.
So let's talk about the options here. No pun intended, or maybe pun intended. If it's just a strangle without the condor. So in other words, just for people who may be new to options, in just a strangle, what we're doing is we're selling out of the money calls and we're selling out of the money puts. The iron condor comes in and buys a further out of the money call and buys a further out of the money put to essentially hedge the overall position, which is where Sean is leaning because he thinks Qualcomm is a little too neurotic for his taste or whatever.
And what I like about this even better is, yes, that's true, JC, but buying that protection in this case, those $10 further away calls and puts, they're very cheap. So you might as well buy them and get the cheap protection. Like the call, for example, the call would cost me 10 cents.
And it'll lower your margin requirement as well.
Exactly. And the put would only cost me about 20 cents. So it's almost like it's free insurance. It's not free insurance.
Okay,
but
so
it's
hold on,
cheap
time out.
insurance.
So hold on. So 30 cents for insurance. And then how much are we getting on the strangle?
So if we just sold the strangle, if we just sold the naked put and the naked call, we'd get $1.70.
Okay, and then 30 cents for insurance. That's not bad. That's not bad.
So I think that's the way, if I were to put this trade on, that's the way I would play it. We'd get about $1.40 net credit for that whole thing. And we got good room from 100 to 120, as long as it stays within that range. I mean, for it to break 100, that's going to be new yearly lows. So that would be pretty significant. So I feel like that's going to be some support. And 120 feels sufficiently far away, at least for the next few weeks, that I would feel comfortable putting that trade on.
I kind of like the Iron Condor there on the Qualcomm. Okay, Shawnee. All right. I see you, dog. I see you. All right. Sean, this was fantastic. Nice little option session. What do you say we hit a little recess there, Jean? Jean, hit it, baby. Jean.
1 second.
There's the voice of God.
Yeah, sorry, I was not ready for recess.
It's like 2 a.m. where he is. Let's give him a break.
We're always ready for recess.
I'm in the wrong. All right, I'm doing it.
No recess. Recess is canceled, guys.
No.
Not on my watch, it's not.
There's a bumper. Oh my God. All right.
Giancarlo.
Guys, I'm waking up and then I was on Slack.
These Californians, man.
Dude, where's
God.
recess? Yeah, where's the recess bumper? All
Should
right.
say recess.
You know what?
Should say.
I know
Should
that.
say recess.
Best I could do is this, guys.
Allow me to reintroduce myself. Let's go. The JC Show. We the top of the charts to give your thesis a jump start. Don't depart from the art and get paralysis. Technical analysis. You know we handle this.
Sorry, guys.
Wow, that was great.
It was. If there's ever a JC show, we already have the intro.
All right, so that's the recess bumper. What do you guys got?
Well, we know what you got. You're very excited for this evening.
Well, yeah, of course.
And you think the Giants have a chance?
Well, Saquon's out. We're getting 10 points. So nobody's really giving us a chance. The way we played in the second half last week, I'm excited.
All right.
We'll see.
All right.
Saying there's a chance. All right.
Definitely. People are underestimating the Giants.
Listen, I feel for Strazza. Both he and I, opening weekend, our football teams both looked terrible. Terrible.
I wouldn't know what that feels like.
That was tough.
You will soon.
I doubt it.
You know, it was so bad for the Giants. You know, Dable's been a good coach so far, but if he lost last week, hot seat.
Well, he's a coach in New York, so you're always on the hot seat, I feel like.
Right, but that would have been tough opening the season like that. So I'm happy for him because I do like him. Would like to see him stay around.
I'm a little salty about Dabo being over there. He's a Buffalo boy, born and raised Buffalo, New York. He was our offensive coordinator. You guys stole him. He never should have left. That's like LeBron leaving Cleveland. Unforgivable.
That's
How
how
is that unforgivable?
hate to break
The guy grew up in Ohio his whole life, and then he decides that he doesn't want to live there for a while, and he wants to go to Miami with his boys. I find that to be perfectly normal and good for him.
That was so stupid. The decision. That was like the dumbest thing we ever did in sports. Was get excited about that. Remember? He did it at the
Didn't he raise a ton of money for charity?
He did it at the Greenwich Boys and Girls Club, and I'll never forget it. There was speculation that because of where he was holding the announcement, it's right off exit 3 there, Arch Street exit off of 95.
Listen, guys,
he was going to the Knicks. Remember that? They're like, why would
I remember being with Josh at happy hour that day, and JV's like, "Oh, he's coming by." I'm like, "You are crazy."
So
listen, guys, you can call me sentimental or old fashioned if you want, but if anyone in any sport, if you become a global superstar playing for your hometown team, I think it's unforgivable to leave your city like that. Not cool.
I'm kind of
he went to Miami with his boys in the winter.
Yeah,
I'm pretty sure he's winning.
Selfish move. Not celebrating where he came from.
You don't see Michael
should be selfish.
You don't see Michael.
I don't see any problem with that.
You don't see Michael Jordan run into the team with the best players on it. You don't see Michael Jordan do it. I didn't see Kobe Bryant.
He already played on it.
I don't know.
How many championships did Jordan win without Pippen?
Dude.
Listen, JC would feel completely different about this if he didn't go to Miami. If he went to any other team, JC would agree with us.
You're really going to take a shot at Jordan like that? That's ridiculous.
Taking a shot at Jordan. I just asked a question. No one's taking a shot.
That back. Wow.
It's just a question. Do you have what's the answer?
Wow.
I just asked a question.
It's 0, but wow, look at you.
First of all, you were too young to even watch Jordan, right? You were still in diapers when Jordan was dominating.
I loved watching Michael Jordan.
Listen, just because you watched a few Jordan videos on YouTube last week doesn't make you. Yeah. No.
Hey, listen, Stock Market Mike, I see you chiming in the comments. No one is disagreeing that Miami's a cooler city than Cleveland. We all agree.
In the winter, hello.
Look, we all agree. We all agree. But listen, with LeBron's money, if he wants to go to Miami on the weekends when he's got a night off, he could hop in a private jet and be there in 2 hours. No problem. He doesn't need to live in Miami.
All right, I got a hot take. Miami is the best city of all the cities in the country. There's no city like it. It's the best. It wins.
No, it's not.
It's fun. It's the best city.
No, it's not. New York is.
City?
New York City. It's the best city in the world.
All right, so New York is Miami. You get one city. New York's not an option. It's Miami. Dude, it's so good. It's clean. You could do everything. There's beaches. It's beautiful.
You could do everything. What does that mean?
Like it's like New York. They got everything. Good food.
It's not like New York. But I'll give you Miami at number 2. I'll give you that one. All right, I'll give you that one.
Perfect. The traffic sucks. It does, especially.
By the way, the traffic sucks in New York and in San Francisco and in LA and in Chicago and in any other city.
I'm not talking about New York, but the LA traffic I experienced for the first time last week, it was okay.
It was a weekend.
It was okay.
There was no traffic.
No, I drove during the week. You forget. Carlo did that drive like right before rush hour.
I think cities are a personal choice. Like, I love New Orleans, right? But somebody else is going to be like, I hate New Orleans. It's a dump, blah, blah, blah. I'm obsessed with New Orleans. I think every Super Bowl every year should be in New Orleans.
I've never been. I've heard it's dirty.
JC, I agree with you on the New Orleans part. I don't agree with the Super Bowl part. I'm not a fan of domes, just in general.
But you know why? I'll tell you why. And we got to hop because we're 2 minutes already past the end of the show. I'll tell you why New Orleans, because where you stay, like where the hotels are, where you party, where all the bars and restaurants are, and where the stadium is all in the same place. As opposed to Miami, the stadium's not even in Miami.
I know.
Or New York, the stadium's not even in the state of New York, or, I mean, we could go down the list on San Francisco's nowhere near San Francisco. None of these stadiums are near the city. It's a pain in the ass.
Good
and
point.
if you're going to spend all that money getting to the Super Bowl, if you're going to spend all that money getting Super Bowl tickets, all that stuff, and now it's going to be a pain in the neck when you're there, like, that's a bummer. I've been to 2 Super Bowls in New Orleans, by the way. I went to Super Bowl 96, Patriots, Packers, and I was also at the Super Bowl where the lights went out. Niners and the Ravens. I was at that one too. Both in New Orleans. Fantastic experiences. I will die on that hill every Super Bowl ever, and that's my recess. Every Super Bowl should be in New Orleans every year.
If we could just get them a stadium like we have in LA, then I would be super happy about that. Because I have stadium envy. I have stadium envy on that SoFi. Wow.
Yeah. Well, yeah, you're a Buffalo fan. They still have O.J. Simpson hanging in the rafters. So of course you know what I mean. Anything's better than that.
Cool it.
No, the stadium in LA is top notch. Nice job over there, everybody. All right. That is our show for today. Thank you to Kimmy Sokoloff. Thank you to Rob Koyfman. Thank you to Sean McLaughlin, our options expert. Thank you, Steve, of course. Thank you to our chat. You guys are on fire these days, our chat. Keep up the good work. We will see you tomorrow. Make sure to go to chartsummit.com so that you register for our virtual conference next week. It's going to be Tuesday evening and all day Wednesday of next week. That's chartsummit.com. And we will see you bright and early tomorrow morning. Adios.
Peace.
Run it.